Hello everyone, this is Shalini Gera and welcome to yet another episode of With Provitt. Today we have a special guest for you. He's none other than market veteran Mr. Sunil Subramaniam, ex-managing director and CEO at Sundaram Asset Management Company Limited and founder and CEO at Sensex Simplicity. Through today's discussion, we fire through some of the key points around us, including small caps, the rally of gold and silver, the India-US trade deal, and the dance of FIIs and DIs keeping Sensex flat. Let's get started. Good afternoon, Mr. Sunil Subramaniam.
Good
Welcome
afternoon.
to With Provitt. How are you doing?
I'm doing very well. Thank you for asking.
It's an honor to have you on our show. Today, we are going to address. I get commonly asked questions about the markets, the Sensex being in a limbo between 84,000 to 85,000, the India trade deal not happening, questions on the rally of silver and gold, questions whether small caps should continue to be in portfolios or not. So, I'm going to start off with a bit of knowledge from you on the markets, on what you've learned about money lessons in the past couple of years, and then we will move on to these specific questions on markets. So let's get started.
Sure.
Whenever I have my financial planning meetings, I meet a lot of investors. Some of these are starting their financial planning journey. Some of them are in their 50s, closer to their retirement, but have never invested in the equity market. So it's an entire range of investors that I get. If you had to describe the markets to a complete newbie in finance or financial markets, how would you describe the markets in a single metaphor?
Well, I would describe it as your employee, okay, who works for you but is very moody and hence needs to be treated with a lot of care and a lot of patience. But ultimately, the market is the employee who makes your money work for you. So I would say that's the best way to look. So the reason I use the word employee is that when you then look at it from a master and a slave concept, right? And historically the slaves. So it was always that perceived that the master is superior to the slave.
Mm-hmm.
But over a period of time, the master becomes so dependent on the slave that the slave becomes the master of the master, because he knows that if he is not there, the master is totally frozen, right? So in that sense, it's the markets, they are an employee, they're working to make your money grow and make your money better. But you have to be careful not to get carried away, be patient and treat it with care as an employee and not get personally involved with it.
Excellent analogy. Employee and an employer and an investor and markets being the same way. Okay. So, sir, I was having a look at your background, your educational background, and the later on career that you took. So, it was actually shocking to see that you actually had an educational background completely in chemistry. Your graduation as well as post graduation being in chemistry, and from there you decided to jump to finance, and throughout the tenure till now you've been in the financial world. So, how did this change from an interest in chemistry to a financial career, a career in happening in finance? How did that happen?
It was surely by accident because I was actually beyond that, what's not in my CV. Post my master's in chemistry, I actually was doing my PhD in biochemistry. Okay. So 1.5 years through that, I had to drop out of the program because of family crisis and stuff like that. So I dropped out of for 1.5 years. So that 1.5 years of my life I spent doing something which had no correlation. So when I came out of that, as a half-baked professional, with a half just part of the PhD, I was not comfortable with the kind of jobs that when I had to take up a job, just as being a chemist in a lab, as a master's, that's all you get. And if you don't complete your PhD, you can never progress beyond your boss.
Right.
So I said that that's not a career which looks very promising to me.
Okay.
Because I cannot complete my PhD due to family circumstance. So then I had to see that what I did in the educational field did not matter in a professional field. And so basically 3 streams of careers opened up. The IAS and the IPS services,
Okay.
the banking services, and the insurance industry. These were the three things. I gave my shot at all of them, at the IAS exam, at the insurance exam, and at the banking exams. So I got selected in the insurance industry first.
Okay.
That happened first. I actually joined Internet India, and I was halfway through a 4 months program with them, where you initially get trained as an insurance professional, when the State Bank of India banking exam result came out. And so naturally, I preferred State Bank to the United India Insurance because of the much larger company. So I joined banking because the past does not matter. Once you are cleared the exam, it's how you do well in your job that takes you forward. So that was very important to me. So it's just by accident that I chose, but it was lucky for me because India doesn't have a undergraduate or a postgraduate program in those days concentrating on finance. So everybody in the bank field or the finance field was from a science background or a commerce background, and it happens so that it was an ideal choice for me because the finance field needs the same skill set that the scientific thinking needs. So I found that I was easily able to grasp the concepts of finance. I then made sure that I wrote all the exams that are necessary to go ahead in my career and to develop myself as a professional. So I passed the CIIB, passed the the CFA program, diploma in business finance, certified treasury management. So I made a lot of effort to learn this field, but it was a level playing field. So only those who put in that extra effort, there was nobody with an advantage or a handicap before that who was coming through. So I think that that I was basically very oriented towards science, I think has helped me to succeed in the finance field. And so I spent the first 20 years of my life in banking. Okay. And then again, by accident, I happened into the fund management, mutual fund industry.
Oh, is it?
Because I had already reached the pinnacle of my profession in banking. I was already corporate banking head for American Express Bank. I usually joined State Bank for about 10 years, and then I moved to American Express when I got an opening there in the foreign bank. Naturally, the financial terms and the prospects were much better in a multinational bank. But then I already reached corporate banking head, and then they were shutting down the bank worldwide. So then I was very, very clear that my family took precedence over my profession. So I was not willing to move to Mumbai. Okay. So if I had to continue my career in banking, I would have had to relocate to Bombay because in American Express, they had allowed me to be in Chennai and run the bank.
Sure.
But another employer would not accept that, right? If I applied for a job, so they would say, no, Bombay is where our headquarters is, you got to be here. So I spent a small 2-year stint in Bank of America with a South-based role, but when this role came up in Sundaram Mutual Fund, which was a nation role, but based in Chennai, yeah, I said, great, because that's exactly what I wanted. But it was a completely new field to me. I had no experience of mutual funds, asset management, equity capital markets, anything in my previous financial services life. So here again, I got the offer, but I had to work hard very again in learning about the market and the economy and everything. So then I spent 20 years with Sundaram. So obviously that has been my learning experience. So if you then look at me as a professional, right, and my financial services career is 40 years old, but my asset management career is only 20 years old.
Yes, that's right. So somebody once told me that there's no one single path to success. So your path to success eventually came from your financial career. I haven't asked you a question yet. I just said that there is no one single path to success. So moving on from your chemistry education, your path of success finally came from your career in finance.
I think there is a path to success, and that's ambition, setting goals which are stretch goals, and there's hard work in terms of acquiring knowledge. I think these are the defining factors, right? So you have to keep learning. So career success is very strongly correlated with a continuous learning process and a continuous stretch ambition process. So what is easily achievable should not be your target. It should always be beyond your reach so that you put that extra effort in. I think these two things in any career, I would say, will suit you well.
Sure. So my next question is that you spent almost 2 decades at Sundaram Asset Management Company managing investors' money. If you look at your early days, in the financial markets. What was that one belief that you held on to very closely that you now think was completely useless?
So if you believe it's more to do with the behavioral finance thing, right?
Okay.
Is that let's say you have bought a stock at 100 rupees.
Okay.
It's gone down to 60 rupees now.
Okay.
So there's a loss in your mind.
Right.
And today, when you make a decision about whether to sell that stock, that loss of 40 rupees from 100 to 60 sits on the mind.
Right.
And so in the initial days of this, I would not go and sell that stock because I waited for it to come back to 100 rupees. That was the biggest mistake because there is a name for it in behavioral finance in terms of the bias that you carry of the past. But in financial management, there's a word called sunk costs. So what's happened in the past is a sunk cost and should never be a part of your decision making on the future.
Today.
Yeah. So which means that if I were able to sell it at 60, but I could buy another stock which will grow by 20, right? I would have made a 30% return from that investment and it would have covered out part of my losses from the previous. But simply sitting and waiting for that 60 to go to 100 and not acting, I think was one of those biases that I had, which the markets then taught me that the buy decision and the sell decision have to be separated.
Okay.
So I think that was the learning. Initially, I did, like every investor on the street does. They all carry this bias about that the hangover of the decision you made in the past. So you look at your portfolio today, it doesn't matter whether that stock you hold made a loss or a profit in the past. Is it worth holding today or selling today?
Or
not? The only thing that should matter. But that realization I did not have at the beginning of my career. And so I carried a lot of junk on my portfolio because of that.
Okay. Yes. Even when I analyze investor stock portfolios today, I see that there may be stocks which people have been holding for the past 5 years, which are still in losses, and people clearly don't want to move out of them. Their intent is to break even, and once it breaks even, then they would want to move on to other stocks. Whereas that's a clear opportunity cost. It is indeed possible to move on to another stock and generate profitability from there, which will cover up for the loss in the earlier stock.
And as a PS to that argument, I also realized that if I had decided after the devaluation that I would hold the stock, right, then it's not, you should not simply hold the stock, you should buy more of it because it's your conviction that it's going to go up. So if you make a decision that I will not sell this stock now, right, I'm going to hold on, it means that you feel good about its future, that at 60, right? It is worth then buying. Yes, because that's what I'm saying. So, but people don't want to throw more money.
They don't want to buy as mine.
So that's one of the lessons that the market taught me very early.
That's right. Done, sir. So next question being, and I'm going to address the elephant in the room now. That is, so Sensex since almost June 2025 till now has been oscillating between 84 and 85,000. Beach mein niche 79,000 tak bhi gaya tha. But every day, one day a good news comes. The DIs end up buying, FIIs end up selling less. The Sensex moves up to 85,000. अगले दिन फिर से profit booking होके फिर वो नीचे 84,000 पे आ जाता है. So what is the reason that Sensex is keeping at this 84, 85,000 level? And every financial planning meeting that I go to, every investor asks me this question: when is Sensex finally going to break out from this level?
So the first thing to answer that, and is that. The value of 85,000 for the Sensex or 26,200 for the Nifty has a certain logic to it in terms of valuations. Okay. Because Nifty's level or a Sensex's level is nothing but the price of a stock.
Correct.
Let's treat the Nifty as a stock or the Sensex as a stock. What does a stock's price represent? A stock's price represents a current discounted value of the future earnings of the stock, right? And when the stock is rightly priced without its value, it doesn't move, doesn't deserve to move.
Okay.
Right? Now, still something moves because demand exceeds supply.
Sure.
Right? So when demand for that stock exceeds supply, despite the fact that it's fairly priced based on the future earnings, if the price shoots up, it becomes overvalued.
Okay.
Okay? So there is a market consensus about this level of 85,000, which says that it's correctly valued based on the earnings projection of the 30 Sensex companies going forward. Right? Now, the issue here is that who is deciding this? So since you specifically mentioned the conversation about Sensex, it's about the large cap space. In the large cap space, right, it is the FIIs who value India. A domestic fund manager values the individual stocks in the Sensex.
Yes.
But the Sensex as a whole is valued only by FIIs because they are investing in India as a stock.
Yeah.
Okay? So, from an FII perspective, India's future potential in the large caps is correctly valued at the current level.
Okay.
Right? The market is at fairly priced. And why are they selling? Is because the selling and the buying are by different FIIs. Because they have different tenor in their mind in terms of their investment approach. A long-term FII may still be buying because he's discounting 10 years cash flows. A short-term FII may be selling because he's in 1 year, this price is not justified because what the price of Sensex is a weighted average over maybe 3 years, 3.5 years, 4.5 years, whatever be the mix of long-term and short-term FIIs in the mix. According to that, the valuation of Sensex is at the medium, it's an equilibrium. Right? So, the reason the Sensex is not able to cross 85, we've got two reasons, right? One is that the existing FIs who have already invested, as you know, 18% of our stock market or 35% of the free float of the market or 40% plus of the free float of the large cap market. When you take overall stock market, FIs own 35% of the free float. If you take concentrate only on the large cap, they probably own 40% of the free float, right? That free float, 40% of the market, which is owned by the FIIs, right? They are holding, have put their money in over many years into India.
Correct.
And they had certain growth projections for India, which since last September have begun to be disappointing their initial estimates of India being a super fast growth country. And it all started because we showed a very bad quarter without any expectation last year, Q2.
Yes.
And then after that happened Mr. Trump coming and then putting on the tariffs, which was seen as a big dent to India's future growth prospects. And hence, those long-term FIs are not committing more additional capital because what price they had paid for the value they saw then, the market is not yet come to a safety zone in terms of correction. And why is it not correction? Because DIs have continued to buy the market because DIs have no choice to put 95% of their money in Indian stock market. So DIs, I don't have another country as an option, whereas for an FII, he has a pool of money and for him India is one stock, it's fairly valued. But if I put in China, it's undervalued. If I put it in Korea, its growth prospects are far better than its current value. So when they compete, so the 85,000 that nobody could have calculated and said 85 is this level. But the market is telling you that it's the equilibrium price between the future growth prospects of the country, right, as defined in the current scenario of a tariff-impacted future for India. India's current is not impacted by the tariffs because the government has taken counteracting steps to meet the thing. So our GDP is not suffering. But our GDP is not going to grow at the level that a long-term FII had put money last year in it, right? So it's stuck at this level. So if you want, I can use a Hindi film metaphor, so to speak, explain this market in just one phrase. There used to be a villain called Ajit in the Indian film industry.
Okay.
And he was famous for a lot of things, but there was one line of which was very famous. So the hero gets caught with him. He'd say, "Isko liquid oxygen में डुबा दो.
Okay.
Okay. So what
Okay.
is it? Liquid इसे जीने नहीं देगा, oxygen इसे मरने नहीं देगा.
मरने नहीं देगा. Right.
So market is exactly in that situation.
Yes.
That FIs are not allowing it to rise,
Correct.
DIs are not allowing it to fall. So that's
Yeah.
why it's frozen at this 85,000.
That's a very interesting perspective that you've given. Okay, sir. So moving on, with 20 years, you managed nearly 80,000 crore at Sundaram Asset Management Company. And this was real money on the table. So what was the most painful mistake that you think you made in the past? And what was the realization post that? What kind of changes did you bring about in your processes post the realization of that mistake?
So I think that I joined around 2005. Okay? And 2005 to 2008, the Indian market was in a boom.
Yes.
2007 end. So all my initial thing there was about the fact that the higher the risk you took, the higher the reward you got.
Okay.
Now, when the global financial crisis hit, 2008 January, right, at that time, the impact of a global phenomenon on our domestic portfolio was not anticipated. The severeness of that correction and the fact that at Sundaram we had held a more pro-risk position in the across our portfolio, which had paid off very well in the run-up. So we were a star fund house, all our funds were super performing well and everything. So when the crash happened, we felt the worst. Because ours were all high beta, high risk, high reward stock. And so it for the next 2 years, it was the worst performing fund house in the industry.
Okay.
So as a result of which, and by the end of that period, we had already got a partner in BNP Paribas, right, as a partner. And they then brought international risk management practices.
Okay.
So I would say the biggest change was that you have to pay greater attention to risk. That in the previous journey, the high risk had always paid off. But over a cycle, you will always have to be prepared for the fact that risk will not get paid off. So you have to bring in the balance of risk and reward in the portfolio. So you might miss the biggest wins, but you will not face the biggest losses. So I would say the risk management process. So we went from, you may say, from an industry parlance, from a Q1 to Q4. But I think that from a strategy perspective, since then, we decided that we'll try to be a Q2, Q3 process. Don't try to aim for Q1 because then you take that much more risk. And then when it doesn't pay off, for whatever reasons beyond your control, it goes to Q4. Whereas if you can take a Q2 kind of a position you aim for, if the worst happens, you go only to Q3. So you'll be in a broad middle band, right? So I think handling with other people's money, I think that's the important lesson because other people expect you to manage their money both for the downside and for the upside.
True.
So that I think was the learning, and that's what changed at Sundaram since then was our risk management processes and became much stronger because of this. Putting in limits on sectors and stocks and how much you can take and what is those exposures. All of those I think were the biggest learning that we realized because I would not wish for that 2008 to 10 phase or 10 in our life again. So that was the key learning as a mistake, if you were to say that.
So risk management became your biggest lesson from that phase. I feel what you say because bringing a 10% alpha over Nifty, I've seen this doesn't make people as happy as a kind of pain that a 10% downside from Nifty in the worst possible condition causes them. But 10% negative अगर portfolio हो जाए तो बहुत गालियाँ पड़ती है. मगर 10%, 20% भी positive हो जाए portfolio तो तारीफ नहीं मिलेगी. Sir, you've been in the financial domain since the beginning of your career itself, and you would have seen cycles. In Sundaram itself, you would have seen the Lehman Brothers cycle, as you just mentioned, to the very recent geopolitical crisis going around us even right now. So during all of these, and 2000 was also something, the 2000 dot-com bubble collapse was also something that you would have seen. So I want to correlate these crises with the kind of hyper investment which is happening in the AI space today. And I want to understand about your learning from these period of crisis. That does it look like a crisis maybe around the corner because of this hyper investment going in AI? And if so, uh, to what extent is India immune, or to what extent is India going to be impacted? Is this spillover going to happen, and will this spillover come onto the Indian tech stocks as well?
So, first of all, I think that I do not agree with the perspective that the AI is like the dot-com boom or the boom prior to the global financial crisis. Okay? The reason is that I think AI is far more fundamental. It's the next industrial revolution. It's not just a tech boom. It's not just it's not, because AI is not tech alone. AI is the thing which is going to change the dynamics of every industry in this world. From education to consumer to manufacturing to everything is going to change. So to look at AI as a tech, so the tech part of the AI, right, is only servicing a huge revolution taking place in the world, right? So the tech stocks in the AI might have gone up a lot and people are looking at it as a bubble. But AI is not limited to an NVIDIA or to an Oracle or something like that. It is fundamentally changing the way everything, right? Who would have thought that we'll use ChatGPT so much as ordinary people in our lives, right? So I think that it is a mistake to treat AI. And these companies are getting the benefit because there are so few of these people who are working in that field who are yet listed in the listed space. So they are naturally getting all the capital flow which is going towards this new industrial revolution is boosting up these stock prices. So I'm not saying that these stock prices won't correct. They will correct because there will be other AI companies which come up and start listing, which are competition to these, and so capital will divert from these companies to those companies. But it will remain within an AI world. Capital will shift to user AI industries where dramatic transformation is happening because of AI. So I think that for me, AI is here to stay. AI is a fundamental way in the way the business works and does. And I think that to treat AI as purely a tech play and then hence compare Indian tech with AI, because Indian companies, right, they will be the AI consultants. So they don't need to be AI within themselves. They need to have enough skills to consult and advise end user companies on the use of AI in their industries. That's the learning curve. It's a process. So they have to get rid of their old staff who are not, willing or comfortable or willing to learn the new AI thing. So they will have to hire freshers from the engineering colleges who are willing to be AI friendly and AI ready. So there is a transformation in a churn period when it will happen. But Indian IT companies will again be at the fore of AI related tech consulting. So, so I don't, so for me, I don't think there's a huge craft happening just because of this AI, because every investor who's putting money in an AI stock, I'm talking about knowledgeable investors in the Western world, is doing so because they are able to feel the impact of this. So it's not just a hawa. So it's not like the dot-com boom when just the eyeballs were getting valuations, right? There is a certain correlation, there are certain things, and so you have to be AI related prepared in terms of where you handle it. So obviously putting more money into NVIDIA, because NVIDIA has already gone up a lot, so obviously there will be a correction coming sometime. But you have to diversify and go into AI influenced industries, if I may rename that word. And will India be a beneficiary? So to the extent that there could be a short-term correction because people feel that AI tech companies have gone up a lot, there is this theory floating around that India being way behind in the AI race, we are the counter to the AI and we'll get a flow, right? But all that is very temporary things. I think India as a country also will become AI ready. We will, but like I said, it is we cannot allow too much AI into our domestic industry, because for us, labor, creating jobs is very important.
Yes.
And AI at its core replaces human mechanical repetitive jobs, right? So we may not adopt AI in the rest of the world because we have a population to whom we need to provide jobs, but we will be very good at AI consulting.
Okay.
Other firms, to other countries. Why has China taken the lead? Because China has an aging population, and they have been feeling the heat of the cost of the wages going up, the supply of labor coming down. So they have been very fast to use. So AI in China, they're using it internally to make better quality product. To do that's why China is way ahead of even America in the AI race, right? But India is not in that situation. We will delay and resist the implementation of AI in an using industry in India, because we don't want jobs to be lost. We don't want to need that. So that's a political and demographic compulsion for India. So we'll do it. But we will be smart with AI, and we'll start offering AI consultancy through our IT firms to the outside world. I don't see any issue with that. We will be a leading AI consulting services provider in a matter of a few years. So to me, from that perspective, from a stock market perspective, right, you don't need to start preparing for a death day, a D-day, that AI, like a dot-com bubble is going to burst. And so is then India going to be the beneficiary of a lot of money coming in? So I don't foresee that as a very significant option. To me, there will be price corrections. The market will always go through overreaction and recover overreaction. That's a natural part of the markets.
Right. So key points about it does not really correlate with the dot-com bubble collapse. They're very, very different. And right now, AI is more not just about AI sector or certain tech sector itself. It is influencing all other sectors around it. And India is going to resist that to a certain extent, because our forte is manpower, and we are going to have more of AI consultants rather than pure AI technology replacing those jobs. In spite of the corrections,
you need the trade deal to be signed.
Do investors need to start looking?
India is actually slowing down.
Is there a belief that you have strongly held on to?
Is there a crash?